Welcome back to Talking Stocks. I'm Joe. I'm here with Todd as always. Todd, hope you had a nice Christmas and hope you're enjoying a little bit of relaxation in between the holidays. I certainly am.
Yeah, Joe, it's always nice. I don't want to say I'm addicted to watching the markets, right? It doesn't sound good, right? But it's always nice to have a reason or an excuse not to have to tune in. So it's good when the market gives us those holidays. It's good to take advantage of and just rest your brain a little bit and do a little bit of reading and kind of some thinking without being influenced by ticks up or ticks down. Hopefully, you had a nice holiday as well.
I certainly did. Yeah, starting to look forward to 2021 now. I think we're all ready to put this year behind us, and so the agenda we've got for you viewers and listeners is really forward looking. We're looking towards Q1 of 2021 and the whole year as well. So hang in there towards the end of the episode. We're gonna give you guys some our New Year's resolutions, and we hope you have some investing related New Year's resolutions as well that we'd love to hear. But first, I want to dive into seasonality, which is something we've talked about on the show several times before. But earlier this week, we published a report specifically on ETF seasonality and the strongest ETFs in the kind of Q1 timeframe. So, starting next week, basically, 1st of January. So, Todd, you can kind of take this how you want, but let's start by talking about these ETFs and what you see that looks promising heading into the new year.
Absolutely. So I guess it's helpful to know. So it's one of 7 key characteristics that we're looking for. So for the Power 7 model that we use for identifying stocks, seasonality is one of those 7 metrics. What's interesting about seasonality, Joe, is that not only is it useful when it's used alongside some of these other 6 components, things like earnings growth and earnings beats and money flow, et cetera, it's also useful as a standalone. And I think that, one of the things that investors always have to remember is that there is no black box secret magic formula that gives you, okay, this is the absolute stock that you have to buy and you're going to make money. It's a guarantee, right? There are no guarantees, right? But what seasonality does, it kind of shows you tendencies. So we have discovered that there are certain seasonal tendencies that specific sectors and industries and individual stocks have. And maybe it's tied to, the demand curve for whatever industry that happens to be in, or it has to do with government budget cycles. There could be all sorts of reasons why there is seasonality, right? We just came out of a very seasonally strong period for retailers, right? So, there's lots of things that can maybe impact seasonality and create these tendencies. And these tendencies are something give you, I guess, an edge that you can exploit. One more tool in the toolbox, if you will, that you can consult and say, there's some pretty strong seasonal tendencies for XYZ stock. Maybe that's one more reason why I should be adding it to my watch list or considering adding it to my portfolio. And that's why we do this every quarter. And we do it on a calendar quarter. And I do it for both exchange traded funds so that I can see, okay, these are the best ponds to fish in. And I do it on individual stocks. And those stock scores, Joe, we're going to highlight some stocks in a couple minutes. The stock scores themselves won't, though, reflect the shift until next week. So for members, link for a free trial. For members, when you go in and log in to see this week's scores, it's not going to reflect seasonality. That'll happen next week, that you'll get that roll. Anyways, with that long, lengthy, tiresome backdrop, I wanted to share my screen and share with our listeners and viewers what the seasonally strongest ETFs are in our research. So I'm just going to go ahead and do that and then pull up that ETF seasonality. And Joe, if you could give me a thumbs up when you see the screen. Awesome. Okay, so the way that I do this is I do it over a 10-year period. So I look at the trailing 10 years. And I want to try and find baskets that are up 8, 9, 10, ideally 9 and 10, but you don't really get 10 out of 10. Something always, can throw you a curveball and derail any given year. So, but again, we're looking for tendencies. So 8, 9, 10 of the last 10 being up for that calendar quarter would be something that would really be attractive to me and something that I would want to be aware of. And what's interesting to me when we look at this list, and again, if you're listening on Spotify or Apple or one of the other services like Anchor, we do post these to YouTube as well. So you can log onto YouTube and you can see the screen that I'm sharing. But I'll walk you through it if you're just listening. So the strongest ones, Joe, are a little counterintuitive in a way, because you've got gold, GLD, agribusiness, MOO is the symbol there.
I love that symbol.
Right? Isn't that great marketing, right? The Treasury Inflation Protected Bond, ETF, TIP, technology, XLK, semiconductors, XSD, and then you drop down to the eights from there, which are also very strong. You've got Europe, the EFA, you've got high yield bonds, you've got biotech, et cetera. So, it's interesting though, of those 9s out of 10s, that you'd have that kind of contradiction, right, Joe? That you would have both semis and well, I guess you could call that semis a cyclical, or but you got technology and gold and inflation protected bonds all up 9 out of the past 10.
Right. It's a little bit confusing from an outside perspective, because gold is seen as like the safe investment in a bear market, if you will. And obviously tech would be pretty much the polar opposite of that. Correct me if I'm wrong. But I can't think of a better example of something that seems counterintuitive on the surface.
Right. And to think that you'd both be able to make money by buying tech stocks and by buying gold in the first quarter is kind of an interesting setup. And I think it's one that's worth noting, and maybe, Joe, what it does is it comes down to looking at and saying, okay, you're coming into a brand new year. You just exited a year. You're going to have some people are going to look at 2020 and say, what an amazing year. You can't do that again. Or, we're bound to give some of that back. So I'm going to play some defense. I'm going to buy gold. And then you have the other crowd who say, oh, wow, what an amazing year that was for technology stocks. I got to make sure that I have enough of those in my portfolio, because there are a number of investors who will look at the top performers from the prior year and say, okay, that's where I need to have my allocation. The other thing that I'll look at, Joe, is I'll look at when I scroll out here and you can see 9 of the past 10. I mean, gold obviously being up last year, where agribusiness and technology and all those were down because we had that really big sharp sell-off right through March. And then we started to rally off the March low. But I also look at the median returns and standard deviations and the correlation to the S&P 500. So, what's interesting about gold is you got that negative correlation to the S&P 500 in the first quarter. So yeah, that can give you a little bit of a hedge, play a little bit of a defense. So it might not be a bad time to go out and add a little GLD your portfolio and see how that performs. The others are a little bit higher correlated, but Treasury inflation protected bonds, the TIP ETF is not. It's only a 0.10, which makes sense, right? Because it's treasuries. And then you can look at the standard deviation. You can say, obviously, your treasury bond's not going to have much of a risk there as far as volatility, whereas you have a pretty substantial amount of volatility in agribusiness and in semiconductors. And then gold, median return of 2.7% over the last 10 years. So the median return is 2.7%. Agribusiness 4.9%, semiconductors 9% median return. So we talked about semiconductors in Q4 as being a very strong seasonal play. It looks like we've got some really nice seasonality that should continue in semiconductors in the first quarter, Joe. And then if you scroll down to the 8s out of 10s, you've got some bond funds in here, munis, corporate bonds. We do have the JP Morgan Healthcare Conference coming up in the beginning of January. That usually is a pretty good catalyst for some of the biotech stocks. And you can see biotech actually has a median return of 8.9% in the first quarter. It's one of the highest ones, right up there with semiconductors. Might be worth taking a look at that heading into the JP Morgan conference. So those are just some of the ones that you want to concentrate on. And then from a sector perspective, the sector ranking we do every week, Joe, we're going into the new year with consumer goods, industrials, and financials and basics, and then technology slightly positive and kind of neutral. That's probably going to shift. We're probably going to see technology reassert itself a little bit in the score. But we do have some pretty good still seasonality in the first quarter for basic materials and for consumer goods. So we might see those continue on. And then if you scroll down to the bottom of the list, Joe, because it's also important to see what ponds you probably don't want to fish in.
Right.
Interesting enough, the actual agriculture ETF itself, the DBA, so you want to be invested in the agribusiness companies, which is, you know, the Tractor Supply, the Deere, and the like, but you may not necessarily want to own the actual grains. You don't want to own corn or soybeans, only up 3 of the past 10 years, and natural gas, only up 2 of the past 10 years. And then everything else is pretty much middle of the road coin flip territory, where you really can't draw a lot of conclusions if something is up 5 of the past 10 or 6 of the past 10.
Yep, perfect. So with that, why don't we hone in on some individual stocks that are equally bullish through the first quarter, whether they're in those sectors that we just covered or not, doesn't matter. Yeah, wherever you want to take it. What are your top Q1 2021 picks?
Well, I'm still going through and trying to find some names to add to my portfolio, and I absolutely love the fact that we do this every quarter, because invariably I'll find a name that will percolate up on one of these lists, and I'll be like, oh geez, yeah, I haven't looked at that one in a while. I really should add this to my watch list and see if I can find an entry. Because Joe, that's what I like to do. I like to use the research, the stock scores, and the seasonality as an idea generation machine. So, I know that it's going to produce to me high quality ideas. So once I see those percolating up in the rankings, then I'll take them and I'll throw them in my watch list, and I'll look at the market and I'll say, okay, is the market giving me an opportunity? Is it a strong uptrend, or do I worry about it or whatever? And then I'll take a look at the individual stock and say, okay, can I get a good down day to add to this position? And I usually will buy positions that I add to my watch list when they're down 3 or 5% day. So yeah, I'll go back and share my screen again, and we can take a look at some individual stocks that are catching my eye. See, that's the ETF screen. So I'm just going to swap back over and now get to the stock screen. And you can see here that I've done the same thing. I've got the last 10 years, and I'm looking for seasonal tendencies, stocks that tend to be very strong in the first quarter. And you notice that Domino's Pizza is very strong. Maybe that's a lot of people buying pizza because it's cold weather and they don't want to go out and they want to have the delivery, or maybe it's because hey, it's football playoff season, they want to make sure they get their pizza for the big game. I don't know. Very strong though. 10 of the past 10 years, Domino's has been up. Interestingly enough, Joe, the score in our research right now is only neutral. So, I wouldn't put that one at the front of the line as a stock to add to my watch list. I'd want to see that score pop up a little bit first. So again, we're looking for tendencies, and then I'm looking for things that will align. So high score, but also strong seasonal tendency. NVIDIA fits that bill. It has a high score above 90, and it's also been up in 10 of the past 10 years with a median return of 12%. So NVIDIA would be one of the names that, I think investors, if you don't own NVIDIA yet, you're going to want, and actually on the chart, again, I'm not a technician, but I will use charts to help me guide overbought and oversold and where I think that there's a good entry point. On the chart, I think that you're setting up for a pretty decent entry point for NVIDIA. So that's one that I would have on the list. You'll also notice on the list a name that you've mentioned in the past before as being maybe a little frustrating, Joe, Booking Holdings, the old Priceline, BKNG. That has not, again, a score that does not confirm the seasonal tendency, but it is interesting to see that as a very high seasonal tendency, given the fact that we do have a vaccine and there is a lot of excitement and potential hope, I guess, that people would still start to go out and plan trips. I will say though, again, down 34%. So the 9 out of 10 last year, that was a pretty painful down year for booking. So again, not one that I would move to the front of the line. Another one though that I would be looking at is Intuit. Intuit, I would put at the front of the line. I'd make sure that I have that. And Intuit again, up 9 of the past 10 years in the first quarter, median return of 8%, very high scoring in our research, Joe, above 90. And, you know, it makes sense. Intuitively, Intuit makes sense, right? Because they get a lot of business from their tax software solutions. And we've got the end of the year. And then, of course, we've got everybody filling out their, using TurboTax to fill out their taxes and file their taxes. So Intuit is another one that I wanted to mention to everybody who's listening. Going down the list, Progressive. Interestingly enough, Joe, I just redid my car insurance and ended up going with Progressive, saved almost 50%. So, you know, maybe the beginning of the year is a good time to go back and take a look at your auto insurance and your home insurance and see whether or not you might be able to save some money. Anyways, yep. Progressive, strong seasonal tendency, and also I happen to know very high scoring in our work. And then another one that I wanted to mention was, I'm going to pull up, let's see. Yeah, I'm going to go back here. So CGen, Joe, which I don't have up here on the screen right now because I just closed my window, but CGen, SGEN, which used to be Seattle Genetics, that kind of fell in the camp of, boy, I love it when I do these screens and a name pops up that I haven't looked at in a while. That's a name that I actually just bought some today. Seattle Genetics, SGEN. And I think that that's a really interesting entry point for the company. I think it's got a lot of catalysts in 2020. It's got some really interesting monoclonal antibodies targeting cancer. It's got some data catalysts that are coming out this year and some commercial catalysts. Got a big deal with Merck and very high scoring in our work. And again, strong seasonality. So there's a smattering. Again, I love that word smatter. So there's a smattering, Joe, of stocks that are both very high seasonal tendencies, but also very high scoring.
All right, yeah, that was an excellent, very diverse smattering. So I always appreciate that. So I want to shift gears now, because here we are. We're recording this on December 30th, so we're 2 days away from the new year, and thank goodness for that. So I wanna talk about New Year's resolutions. You've been teasing me about yours, and you haven't revealed it yet. So I know we each have one. So I'm gonna go ahead and let you go first. So viewers and listeners, these are investing related New Year's resolutions.
Yeah, and I hope that I would love it if you're listening to the show, mention in the comments what your investing resolution is. Maybe we'll mention on the show next week if you've got some good resolutions. My resolution is something that I've actually, it's not the first year I've actually had it on my list of resolutions. It's something that I've struggled with a lot, Joe, in my career. You know, I've been investing in stocks since the 90s. You know that I'm a very systematic and rules-based investor. I always say, you know, plan a trade and trade your plan. And I think that I have some really good rules and some really good controls, practices, and processes for identifying stocks and then entering them. What I want to do better on in 2020 is I want to do better on my exits. So I want to spend more time in 2021. I want to spend more time on my sell strategy. And when I say that I want to spend more time on my sell strategy, I want to do a better job of reducing the average loss of my losers. So historically, my entries have been very good. My idea generation has been solid. And I've got a really high win rate because of that. But if you take a look at your gain to pain ratio, or, you know, there's different ratios out there you can kind of look at and say, okay, just on a very basic level, you know, how much am I making my average winner versus how much am I losing on my average loser? I feel like I can improve that number. And part of the problem for me, thing that I've realized, is that I have a tendency not to sell unless my catalyst is busted. That was something that in 2020 I was really good about. Don't sell unless your catalyst is busted. But I think that oftentimes price can lead the busting of a catalyst. So oftentimes I will know if I'm right away. If I put on an entry and I buy a stock, normally if I've timed it right, if I've entered right, I'm going to be up on the stock right away. If I'm down on the stock right away, I need to do a better job of taking a look and saying, okay, did I miss something? Is there something in my catalyst is there something that I missed to make sure that I'm really that comfortable in holding on to the losing stock? And, I don't necessarily, I hate saying, okay, it has to be, O'Neill did the 8% rule. If I'm down 8%, I'm gone, right? That was how he controlled it. I'm not going to say that. I'm not going to have that line in the sand. But I think that if I'm down more than 10% in a stock, I really, really want to take a look at it and make a decision and be honest with myself and make sure that I'm not, justifying holding position in a hope and prayer kind of way. So I guess, that's a long kind of drawn out, but for my resolution for 2021, I want to refine more my sell strategy so that I can make it a little bit more systematic and hopefully improve my gain to pain ratio and maybe, tweak and boost my average win to average loss.
Awesome. That's great. And it's actually one of the things that I struggle with as well, because my portfolio right now it's pretty mixed. It's a lot overall, there's a lot more green than there is red, but there are still a few that I'm stubborn about, that I'm carrying some pretty significant losses on. And my attitude is, well, I'm young, it'll come around eventually. And maybe that's the right attitude, maybe it isn't, but one way or another, it's a very frustrating experience. So an example would be Dropbox. I've held Dropbox for a solid couple years, bought it at 26, and it's never gone above 26 since I bought it. And it's inching upwards. And at this point, I think I'm going to wait it out. But I have some others that just have, like, I owned Boeing for also a couple of years and thought that they would be able to climb out of the hole. And then it was just bad news after bad news after bad news. And I said, screw it, I'm going to sell it. And I sold when it hit 200. So I'm improving on that, but there's still a lot of room for improvement. So,
yeah, and one of the things, Joe, just to follow up on what you were saying,
yeah,
you
go
had
ahead.
that Dropbox. In the Dropbox, you say you bought it at around 26. You never kind of got eclipsed back up above that 26 mark. And I think that's kind of what I was hinting at before, which is that, when I'm right about a stock, when I've identified a great company, a great business, and then I've got my entry right, I'm up pretty much right out of the gate. I mean, I might be down for a week or two, or maybe it bounces around a little bit. Then I can use it if I've got a starter position. I can use that to build it up to a normalized position. But if I'm down right away on a stock, to your point, oftentimes, like, if I get down more than 10% on a stock out of the gate, I end up being wrong. One of the things that prompted me to really kind of think more about this was that I'm a big believer in, big follower of the Motley Fool. They do a great job. They have a lot of awesome tools. And one of the things I do is I participate in their Motley Fool caps game. And it's a great way of kind of reinforcing and keeping a track record of your what you're buying, what you like, what you don't like, whatever. And I have been very fortunate to do very well in that game. Last week, I'm in the top 1% now of all players for the first time. And I was looking at, but what was interesting about that, Joe, is I was going through it, I was looking, okay, let's look at my winners, let's look at my losers, let's see how it all works. And buy and hold absolutely dominated, right? It was a strong bull market. I identified a number of stocks like Trade Desk and Shopify, held them on, and those way more made up, just a few of my big winners, way more than offset all of my losers combined, which is great, right? That's what you would expect. You'd expect that, 10 to 20% of your picks really do a lot of the heavy lifting in the portfolio. But I started looking at those losers again, And I was like, yeah, I'm doing fine. But if I'm in the top, I can't really complain about being in the top. But I'm looking at it, I'm saying, why is that still in the game? Why am I still riding that stock? And I think that's kind of what we're talking about here, and with your thing is just trying to figure out, once you have it's easier in a way to develop a system for identifying and buying, and much harder because of emotion to figure out when to sell.
Right. So now for my New Year's resolution, my now former company sent me this wonderful, it's a smart notebook. So shameless plug. It's called a Rocket Book. I'm still figuring out how it works, but long story short, I'm going to use it to basically keep an investing diary or notebook. So one of my issues is, and I'll give you an example. I tend to buy something and I hold it for too long. It peaks and I end up holding it way after the peak, and I have to sell where I shouldn't. So what I'm going to do is whenever I buy something, I'm going to write down, obviously, when I bought it, what it is, what I bought it at, how long I want to hold it for, and what I would ideally like to sell it at. And eventually I'll want to work up so that I have basically just a bunch of like limit orders, stop orders in my portfolio for everything. So, if Visa hits 400, just naming a random stock and a random price, then it would just automatically sell. So if I'm, off doing whatever and it hits 400, while I'm at the doctor's office or something, I don't have to worry about it. So really it's about planning trades. That's what my New Year's resolution comes down to. I would advise that for everybody who's watching and listening, because I end up making really stupid mistakes and getting greedy. So my example, going back, is Moderna. I've talked about it on the show before. Obviously, it's been all over the news. And the price has just plummeted. It's been so depressing to watch. And I'm still up on it, but I actually just sold it while we were recording because I needed to let go and I was sick of watching it just slide and slide and slide. And so I sold it for like a 42% gain. And you know what? Good enough. But I should have sold when I was up 100%. Because I,
you know what, though, you protected yourself against what Peter Brandt calls the popcorn trades. Peter Brandt's in the Unknown Market Wizards book by Jack Schwager. Just got it for Christmas. I've been reading it. He's also pretty active on Twitter. And he talks about these things called popcorn trades, where you make money on it right away, just like a popping popcorn kernel. Yep. Pop, and then the kernel comes back down and falls away all the way to the bottom. Mm-hmm. And so you make the money, but then you watch it go all the way back. And right. That's what you want to try to event. And, you look at it and you say to yourself, okay, well, you just made a very nice, congratulations, made a nice win on that trade, but could you have done better? And I think that's part of investing journal is so important, so useful. I'm excited that you're doing this because I think that's going to be a fantastic experiment to be able to track your thoughts and put them out there and then scan them and have them digitize them and so you're able to go through and look at them, maybe sort them and kind of look for trends and things that you've said or done or where you violate or whatever, whatever it happens to be. I think that could be so useful. That's a really great, I'm looking forward to next year. We'll have to go back and say, all right, Joe, how do we do on that? That's great.
Right. It'll be fun to look back, especially after having like a few years worth of notes and, looking back when it's 2024 and looking back on what my plans were and what my trades were in 2021. It'll be really fun to kind of, what am I trying to say? Chronicle that over time.
Yeah. I was just also thinking about just on for our listeners who maybe are struggling with some of the similar things. Matter of fact, someone had tweeted it this week. I'm not sure if I replied. If I didn't, I apologize. But it was this the same thing basically. Have you ever ridden the stock up and then back down, and how frustrating is that? And that was something that I do a very good job of controlling. It's part of my rule base. If I do sell vertical, so I call it selling vertical. So if you get a chart that moves up vertical like this, then I will be taking some off. Oftentimes we'll leave some on, because I do believe that you get longer benefit of the longer term trend. But I mean, like, look at even like Tesla or Shopify that I've owned for years and years and years, right? I have trimmed those, right? There are periods where those things have run, and I've taken and put some of that money in my pocket, and then used that to diversify and buy other stocks. So I think that you can have kind of a hybrid, Joe, as you're thinking about it and saying to yourself, I'm going to put some of that profit in my pocket when it goes vertical like that. And then, have some sort of a discipline or a strategy for making sure that you don't ride that trade all the way back down and see that popcorn fall all the way back down to the bottom of the.
Absolutely. It's such a terrible feeling knowing that you've missed the peak like that. But it's important to, one of the things I've learned, and I learned early, is to not get too greedy. So, if you get to a point where you own something like Tesla or Shopify that's just rising just like a rocket ship, and you're up 100%, you're way better off to just liquidate that than have it plummet and then wait for another meteoric rise that may or may not happen.
Yeah, and I mean, I think that I usually define put stocks into two camps when I put a trade on, Joe. So I've got my forever stocks, and a Shopify fits into my forever portfolio. And then I have my rentals.
Yep.
And a rental would be kind of like a cyclical based trade or a seasonally based trade. So I might, like the semiconductors for me, in many respects are more of rental trades for me. So I'm much more willing to have a short leash with a rental trade than I am with a forever stock. So, if I've identified a stock that has the characteristics of a forever stock, then, good management, big addressable market, disruptive technology, whatever, then what I'm really trying to do is I don't want investors to think that I'm trying to get too cute with the name, because I think when you get too cute with it, you can do yourself a disservice, right? But what I am saying is that when I get uncomfortable with the weight of the stock in my portfolio, so if Shopify goes up 1,500%, which it did for me, or Tesla goes up 1,500%, which it did for me, then because of the weight now of my portfolio, that makes me uncomfortable. So I'm going to trim that back to a reasonable weight again. So I'm still benefiting from that part of my forever portfolio, but I've also put some money in my pocket. Does that make sense?
Absolutely. Definitely does. So before we part ways and cruise into the new year, I want to put you on the spot here, because tomorrow I want to act upon this New Year's resolution a little bit early, and I want to buy one stock. I'm not going to buy a ton of it. I'll buy, like, as you say, like the kind of starter position as far as allocation in my portfolio. If one stock, if I'm gonna any stock, what should I buy tomorrow?
Oh, you are putting me on the spot.
Yeah, I know.
Okay, so here's the problem with that question, and this is something very common that you'll see investors trying to figure out. Okay, what am I? You need to identify stocks. I have a list, and I shared it on Twitter recently. You can follow me at EB Capital. I have a list of probably 10, 12 stocks, something like that I'm watching as we go into the new year. Now, I don't know on any given day if one of those stocks is going to give me my entry. Because you'll remember a couple minutes ago, one of the things that I said is I don't like to buy just to buy, especially after markets had a big run. I like to buy if a stock has pulled back and kind of checks my boxes. So on a down 3 to 5% day. So, for example, I guess I'm not going to answer your question for you, Joe. No, but what I will say is today I took Seattle Gen X, which is now CGen, and the symbol there SGEN. It checks off all of my boxes, and it's pulled back, and I can define my exit, meaning that you're close to support, and I can say to myself, I think that I'm going to be okay in here, and I'm probably not going to violate that 10% kind of area where I'm going to be really nervous about continuing to hold the stock. So maybe it's CGen that you're looking at, Joe. But
All right.
there are others that we talked about on the show that you could also be looking at. And again, I think that, you know, if we sell off on the last day of the year, maybe that gives you your entry. And the other thing, Joe, that I like to do is I oftentimes will buy in the last 10 to 15 minutes of the day. And I found personally that that's really good because you get intraday ups and downs and swings, and you won't get the low or whatever. But I now know that I'm not going to get run over if I put a trade on at 2 o'clock in the afternoon, right? I've only got 2 minutes left. I can see what the imbalances are, and I can put that on and feel good about, okay, I got a good entry, and now let's see if she rallies the next day or two.
Yep. All right. Well, good answer to a terrible question. Don't ever ask Todd that question, viewers and listeners. You will not get a straight answer. Lesson learned. With that very unclimactic ending, do you have any parting words for us before we head off and we'll see all of our viewers and listeners again in 2021?
Yeah, I would love to hear what other people's investment resolutions are for 2021. So I hope you'll take a second and just like and subscribe and put in the comments something that you plan on trying to improve in your own, process of planning trades and trading plans in the coming year.
Absolutely. All right, we'll leave it there. Happy New Year, everybody. We'll see you next week.